you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and the question is the Federal Reserve responsible for the American debt crisis that we are currently in right now? And so during this video, we're going to study things like M2, money supply. We're going to look at the devaluation of the dollar, deficit spending, and start asking the question, why did this happen and who's responsible for it? And what I mean by who's responsible for it is who's responsible for the overwhelming amount of inflation and the overwhelming unaffordability going on. Well, literally, guys, it's going on around the world. And please don't forget to like this video, subscribe if you haven't already, if you find value. If you don't find value, I get it. But if you find value, please hit like. And also, you guys, don't ever forget, I have a free home buying course. I've made this for you. I pay out of my own pocket to provide it. So if you want to empower yourself, if you want to be a stronger consumer, if you want to get out of the rat race and you don't want to be a victim of the Federal Reserve, please take the class. It will help you empower yourself and help you become an expert in real estate. But whether or not you take the class or not, I really hope you guys enjoy today's video. So we're going to stick with this article, and I'm going to show you guys, as I'm reading this article, about 5 different data points that kind of supports what the article is saying. Now, the name of the article is Federal Reserve Responsibility for Consumer and Government Debt Crisis. Okay, so we're going to check out the first paragraph here, which is saying, according to the Federal Reserve, credit card delinquencies increased, this is a shocking number, you guys, by 50% in 2023. Again, delinquencies, and just one delinquency can destroy your purchasing power. Just one late payment, guys. So try to never, ever, ever be late on your credit card payments. But that did increase, shockingly, 50% in 2023, while consumer debt grew to $17.5 trillion. A recent survey by Clever Real Estate found that 3 in 5 Americans have credit card debt. So again, 3 in 5 Americans have credit card debt. That's 60%. And 23% of Americans increase their credit card debt every single month. So a quarter of all Americans are staying in debt. At least a quarter of all Americans are staying in debt. The survey also found that 48% of Americans, including 59% of millennials, use credit cards for essential living expenses. And I'm going to tell you guys right now, there's really only one way you want to use your credit cards, and that's by using your credit cards to get cash back. As long as you pay your entire credit card balance off by the time it bills, or even before it bills, you're fine to do that. The problem is people aren't doing that. People are leaving the balance on their credit card, and so they become a prisoner to credit card debt, especially because it's almost impossible to pay credit card debt off if you're only making the minimum payments. So it's a trap. It's a prison. Being in credit card debt is financial suicide, especially if you're living paycheck to paycheck. Let me show you guys the delinquency rate around the nation. And this is absolutely shocking. Take a look. So y'all may have seen this circulating around X. I almost said Twitter or Tweeter or however you pronounce it. And I do have an account. I do not know how to use it, but I am posting on there a little bit. But take a look at this, guys. This is credit card delinquency rates. And take a look at my home state of Texas. In Texas, the delinquency rate is 25%. How is that? How are 1 in 4 accounts delinquent in Texas? How's that possible? And look at Oklahoma, 28%. Alabama is 31% right here. I mean, holy smokes, you guys. Mississippi, 39%. Mississippi is in bad shape. Louisiana, 32%. And you guys notice this whole little cluster right here also has the top delinquencies for home loans. So top foreclosures going on, as well as credit card delinquencies. What I'm really surprised is California is only 15%. New York's only 15%. Florida's only 15%. Those are some of the areas that it's the most unaffordable to live, and yet they have some of the lowest delinquency rates. That's pretty surprising to me. But regardless, the delinquency rate is blowing up and skyrocketing across the nation. A 25% delinquency rate in Texas is unacceptable. The over-reliance on credit cards and the accompanying increase in consumer debt are consequences of our fiat money system. Since Richard Nixon severed the last link between the dollar and gold in August of 1971, the dollar value has declined by 87% based on the government's understated consumer price index numbers. This means that even though Americans' nominal wages have increased, their real wages have declined as their dollars buy less, which means adjusted for inflation. So when we adjust for inflation, ain't no one keeping up with the unaffordability. They're putting an overwhelming amount of burden on the backs of the consumers. Now take a look at this, guys. This is visualizing the decline of the US dollar. So going back all the way to the 1900s, obviously you guys, it started way up here, but look at the devaluation. I mean, it started being devalued well before the 1970s. But once we hit the 1970s, I mean, the devaluation is just shocking. And if you guys come down here, this is pretty interesting. You can see how much $1 bought you back, in the previous years. Starting with 1913, you can buy for $1 30 chocolate bars. Okay, in 1933, $1 would get you 10 bottles of beer. Imagine that. Well, I don't want you to be an alcoholic or really to drink, but I'm just saying that's a lot of beer to buy for $1. Now, fast forward to today, $1 will get you some McDonald's coffee, which is not bad. So replace the 10 bottles of beer with a cup of coffee. Not a bad substitute, in my opinion. Let me know what you think below. Now, this next paragraph is pretty heavy, pretty accurate. The continuing erosion of the dollar's value makes it impossible for many Americans to accumulate meaningful savings. So Americans can't save money. Those Americans who can save may actually lose money by doing so, thanks to the Federal Reserve inflation tax that erodes the value of savings. This is why Congress has felt it necessary to provide tax incentives to encourage saving for things like retirement, education, and healthcare. But I will argue it is okay to save your money, but don't just keep it in a normal savings account. What I do is I buy T-bills because that gives me over 5% back annually. But take a look at this, guys. This is a chart from Fed Economic Data of the personal savings rate. And I'm showing you, basically, you guys, we're at 3.8% right now. So as a result of the overwhelming inflation, consumers can't save money. 3.8% is shockingly low. Now, if we go back to the last inflationary battle, let me move my picture, which was in the 70s and 80s, you guys can see the consumer was way better off in the 70s and 80s with an ability to save in the double digits from anywhere from 10 to 14% was a savings rate. About 10 to 13% was a savings rate from the 70s and 80s. So again, you fast forward to today, the consumer cannot sustain and keep up with these prices. The fundamentals are just not there. And the price run up and the wage run up, all these things was artificially created by money printing through lockdowns. This isn't real growth. In other words, it's printed from a printer. It's not like hardworking Americans got up and said, I'm going to empower myself. I'm going to start making more money. I'm going to be wise. It's not that. It was just printed from the government. Therefore, there are no fundamentals attached to the recent growth. This is wild. This is crazy. Let's move on. Now, Congress could help protect Americans from the inflation tax by forbidding the Federal Reserve from purchasing government debt instruments such as Treasury securities. I'll also throw MBS in there, or mortgage-backed securities, but regardless. However, since this would end Congress's ability to run up huge deficit, thus forcing it to par back the warfare state, it's unlikely such legislation would pass. And just to give you guys an idea of the deficit spending that's going on right now, it's just shocking. I mean, this is 100% the Fed's fault. 100% the Fed's fault. And I argue the low interest rates. It's not the high interest rates. It's the low interest rates for too long. Look at the deficit spending. When we were in the Great Recession, the GFC, the Great Financial Crisis, the most the deficit got to was 1.4 trillion. You guys, in 2023, we had a deficit of 1.7 trillion, which means the deficit was greater in 2023 than it was at the peak of the great financial crisis. So the deficit spending is if we are already in recession. I wonder, is that why we haven't been in recession yet? Is it that government deficit? Is it the government spending? Is that why we haven't been in recession? And if that's the case, doesn't that mean it's just making things worse? Doesn't that mean more people will be hurt and the severity of that pain will be greater because the problem isn't being fixed, it's being made worse? Isn't that what that means? Comment below. Either way, let's jump back in. The reliance of so many Americans on credit cards for basic necessities is one reason why many Americans are dissatisfied with the economy. The large amount of consumer debt is also a reason the Federal Reserve will not increase interest rates to anywhere near what they would be in a free market. And again, that's because they're manipulating this market. In a free market, it's saying rates would be higher and probably things would be way stronger because you would have a lot more of the boom and bust. They're just trying to give us a constant boom without the bust. It's not working. The problem is compounded by the fact that investors and businesses have become addicted to near zero or at a zero interest rate, or ZIRP, zero interest rate policy. The Fed's relatively modest rate increases over the last couple of years caused many experts to warn that the Fed was going to throw the economy into a recession. So a Fed-induced recession, is what we've all been waiting for. But a Fed-induced recession, I mean, why would the Fed induce the recession? Because they created a reason to create a recession, because they stimulated the economy too much during lockdowns especially. The Fed, though, has been able to claim recession has been avoided because the Fed kept rates relatively low and because government statistics are manipulated to understate the real rates of unemployment and inflation. I like that. I agree with that. The numbers and the data is well known to be manipulated. Now, just to put this in perspective, yes, historically interest rates are not high. They got to around the 8%. Last time it was that high was, in the early 2000s. But the thing is, the prices of houses are too high. So yes, I understand in the 70s and 80s, you can see here that rates got up to 18%, but the values of houses was way lower. And we see that in things like the PE ratio. But regardless, this run up right here, going from basically 3% interest rate to 8% interest rate in this amount of time, shocked the market. It is crippling businesses. It is crippling the financing sector. They are doing this to us on purpose. And the crazy thing, you guys, is we want them to. The crazy thing is people have to get hurt for us to win. But always remember, we didn't make this mess. The Fed made this mess. The Fed cannot indefinitely keep interest rates low without causing a dollar crisis. This will either be caused by or result in a rejection of the dollar's world currency status. At that point, interest rates will skyrocket, and consumers and businesses that have been relying on debt to cope with the Fed's dollar destruction will find the piper at their doors demanding to be paid. Now, just to visualize this, when it says that the US dollar is at stake of not being world currency, that could be a huge problem. Now, some of the people that have already joined what's called BRICS is trying to basically get rid of the dollar. The thing is, guys, is what is going to replace the dollar? Maybe crypto, centralized. There's nothing that can replace it. But regardless, what I'm pointing out here is the world doesn't want it anymore, probably because the US is also bullying the world. But right now, the members are Russia, China, India, Brazil, and South Africa, with a few new members and also members that have applied for membership. So, from a mass standpoint, it looks like half of the world no longer wants to use the dollar. So in time, obviously, that can become a major problem. Let's keep going here. The economic crisis will be worsened by the moral crisis caused by the belief among too many Americans at all levels of society that they have a right to a government-provided economic security at the expense of their fellow citizens. Comment if you agree with that. That one hits home. That one hits home for me. I want to know if that meant anything to you. So please, guys, comment below. This will result in violence and the growth of authoritarian political movements. That's crazy. The last paragraph here. The collapse of the fiat money system and the accompanying welfare warfare state also provide an opportunity for those of us who understand the truth to build a society based around the principles of liberty. We must continue our efforts to reach a critical mass of people with a message of liberty while making plans to ensure our families can take care of themselves when the next crash occurs. Which brings me to my final thing. I have a free home buying course. I made that for you for free. Okay, it's for you. It's for free. For me, it costs money, and not just my time. It costs me monthly money as well, which is why I don't have a grading system. If I have a grading system, it costs me double. But the thing is, guys, I'm trying to provide you with something to empower yourself. Like the article is saying, part of the way to get ahead of this and to be a winner in a crash is by empowering ourselves right now, being aware of the situation. A lot of people are like, oh, you're just scaring people. You're just trying to make people fear. You guys, we're using data. We didn't make this mess. The Federal Reserve did. So I think it's really important we slow down, take a look at the big picture, empower ourselves in the meantime, and don't be stuck in the rat race. If we want to get ahead of most people, honestly, you guys, it's really not that hard. Usually, we just have to make a decision to go after our goals and stick to it. That's usually all we have to do. So if that's what you need to do, please just get up and just do what you got to do. Start making money, start rebudgeting, whatever it is. But either way, you guys, I really hope you guys got some new value, insights, and perspective today. And if you're out there investing in real estate, you already know I wish you luck, and I hope you win.